everyone, welcome to the final walkthrough. Thank you for joining me on another episode. I am your host, Johnny Noriega. Special episode today. I am solo here in the studio, but I do have a special guest, and that is you, the potential home buyer. Today, we're going to go over the three main parts of what you need to look out for when buying a home. We'll dive into them little by little, and hopefully at the end of this, we will answer the majority of the questions you might have. And as always, my team is here if you have any questions or concerns or want to get the process started. So let's jump into it right away. The number one question that I get a lot of times when someone applies for a mortgage is, what's my credit score? I don't know my credit score. Credit Karma tells me one thing. My bank card tells me another. So a lot of times it's about pulling the actual credit from the lender. And it's funny to think about because a lot of my clients are scared to do that initial credit pull. It's because they might not want to know, right, what's going on within their credit. But it's very crucial in getting the correct answer in a form of a mortgage application. So let's dive into credit a little bit. Most banks, including mine, will accept a 580 credit score or higher. Not necessarily the best news if you do have a 580, because things like down payment or interest rate or closing costs are a huge factor in what your credit score is. So if there's a way to improve it from the initial credit pull to your home purchase, we will do that. Some facts that we pulled up before shooting here. The average credit score in America is 714, which is a good score. It's not a great score. It's not a bad score, but it's right in the middle. And a lot of times with a 700 credit score, you can get it in a home and actually get down payment assistance as well. But what happens if you pull your credit and you're in the 400s or the 500s? Well, there's a couple things we can do. As a loan officer, we have the ability to check your profile. And if there's items like collections or potential late payments that you are not aware of, we will attack them right away. And hopefully in the next few months, it's something that we can take care of. And yes, a few months. Credit is one of the hardest things to overcome when it comes to the full profile of being pre-approved. One late payment, one collection, I've seen borrowers go from a 720 credit score down to a 620 overnight because of one small collection or one small late payment. And a few times you can dispute some of these items if it was some sort of identity theft or something that we could easily rectify. But a lot of times, if it's just something you forgot or if it's something that you haven't paid, it will affect your score. And if not taken care of, could take a long time to resolve. Also, credit is responsible for the amount of fees that you're paying at closing and what your interest rate will be. And at times where we have news all over where rates are the highest they've been in the last 20 years, it's important now more than ever to make sure that your credit score is in the best possible scenario. Now, how do I help as far as credit? Now, I'm not a credit expert, but I can give you some small details in how to raise your credit. And a lot of things are the basics, right? Make your payments on time. Avoid late payments. No collections. So if you do get a letter in the mail or a phone call, don't ignore it. Open it. Answer the phone call. It's better to pay the $40, $50, $100 upfront than to have the consequences of a late payment hit or a collection on credit. So credit score is important also when it comes to down payment assistance programs. Here in Illinois, we have IDA. IDA requires a 640 credit score. So a 640 credit score will determine the difference between you bringing an extra $6,000 to up to $10,000 a day of your closing, which is what they offer for down payment assistance. So that's an important detail as well. It also affects how much you will be bringing the day of closing. And again, once it's in the 5s and the 6s, it does take a little bit of time. But once you have it in the 700 plus, you're in good shape. So credit is the first part. And a lot of times clients, borrowers are scared to pull the trigger on the initial credit pull. But credit pulls in general only make about 10 to 15% of your overall credit score. So nothing to worry about if one or even two banks pull your credit score. What you don't want to do is start applying for multiple lines of credit, for a mortgage, for a credit card, for a car loan. That's when you'll start to see a decrease in credit. But if you shop around your mortgage with a couple lenders, it will not make a significant amount of damage in your report. Trust me, that late payment, that collection will be a lot harder on your score than one or two credit pulls. So credit's one of them. Let's go to the second part, income. In this day and age, especially after COVID in 2020, a lot of people changed careers. A lot of people lost their jobs and now they're in different fields. Some even have changed the way that they've gotten paid. I have borrowers every day that went from being a bartender or a server and now they're in college or trying to get their degree in graphic design. And they tell me, look, I don't want to apply because my credit history is all over the place. COVID laid me off and now I've only been back to work 6 months or a year. I don't want to buy. That's another misconception. When it comes to income, banks generally do want to see stable income, so they will ask where you've been the last 2 years. That doesn't necessarily mean that you have to be at your job for 2 years. If you've been at your job 1 year, and then before that, you were there another 12 months, there's your 2-year work history. You can qualify to buy a home. It gets a little interesting, though, when there are gaps. So, for example, I've been at my job 6 months. Prior to that, I was off for a year. I was hurt, or I just took time off. Before that, I worked 6 months. Before that, there was a gap. So it's very important to talk to your lender and go over the options that some loan programs might have in regards to your work history. So a lot of times, 20% down or higher programs aren't as strict as if you were wanting to get the 3% or the 5% with down payment assistance. So again, important, the initial consultation, make sure you put everything on the table. I've been here 6 months, 3 months I was off, I was working for a year, and go from there. And I can't stress how important it is to know your work history. There's been a few times where I've sat with clients and they either just don't know or they forgot because they've had so many jobs in the past, but it's important to structure your history. So again, the last 2 years is crucial when it comes to applying for a mortgage, and you don't have to worry about not being at your job for 2 full years. The second part to income is, how do you get paid? Most Americans have a W-2 job. What does that mean? It means that every time they get paid, they make $20 an hour, $25 an hour, and then they have their deductions. Federal taxes, state taxes, Social Security. That's one of the easiest way to calculate income when it comes to buying a house. If you make $50,000 a year salary, or if I make $25 an hour and I work 40 hours a week guaranteed, it's easier than if, let's say, you're commission only, where every check is different. Sometimes I have good sales, sometimes I have low sales. In that case, banks will want to see an actual 2-year history of your commission. Same thing if you get paid cash. If you're a small business owner, what comes in versus what gets paid in taxes gets tracked annually. In the off chance, sometimes you do file taxes quarterly. Some companies do that. But for the most part, you're filing taxes year by year when it comes to your self-employed income. So if, as we're filming, we're in the September, October months, if you have a 2022 tax return that is not enough to get you a home, then you will have to wait until the following year in order to qualify for the home. So how you get paid is also crucial. What is not acceptable is income that isn't reported. So again, I talk to a lot of my clients that get paid cash, they don't report it, they drive for Uber, they don't report it. Aside from it not being, I think, legal to not report income, it's also not able to be used to buy a home. So it's very important that you set your numbers up, get with a good CPA, go over the do's and don'ts with the loan officer as well before filing. Because again, a lot of times self-employed borrowers, they make a lot, they make good money, but then they also write off a lot, which then doesn't allow you to buy as much house as you'd want to. But for the average person that works a W-2 job, I want to share with you the easiest and best type of calculation to find out what your buying power is. So I'll give you a quick example. Let's say we have someone that makes $50,000 annually. The banks will allow you up to close to 50% of that gross income to be used, gross monthly income to be used for your total payment. So what that means is if I make $50,000 a year, that means I make $41.66 a month in gross income. So what that means is half of that can be allowed to be used for your total number of payments, including your mortgage payment. So that means $2,083 of your gross income can be allowed to be used for your mortgage payment, for your car note, for your credit cards, for your student loans, etc. So if I have borrower A that has zero debt, has a few credit cards open, but has paid them off completely, paid off their car, no other debt, they're allowed up to close to a $2,100 a month mortgage. Now, if I have the same borrower B or different borrower B that is making the same amount, $50,000, but has a $500 car payment, has a $150 a month personal loan, has minimum payments on credit cards that equal about $200 a month. Now your limit is about $1,200 a month in mortgage payment. And that could be the difference between buying the house of your dreams or buying something a little bit less than you might want. Now, that's just a rough overview. Obviously, reach out to me if you have any more specific questions on your income. Income also determines your buying power. How much can I buy? Even if you have an 800 credit score, if you're only making $15, $16 an hour, there will be a max cap of how much house you can buy. But the less debt you have, the better position you'll be in to buy a home. And the final thing that I want to focus on is assets, which a lot of my clients think is one of the hardest things in order to buy a home. The money that I need, the down payment, the closing costs, where does it start? Well, let's start with what the banks actually require first. The first part of the amount of money that you'll need is the down payment, the percentage based off the purchase price. Most time for first-time buyers, they'll only ask about 3% to 5% of the price of the home, depending on your credit score. So again, that's where credit comes in. So if you have a 740, 760, you're probably only going to be required to bring 3%. If you're in the 610, 620, 630, you'll probably be asked to put about 3.5 up to 5% down, or even more. I've had some buyers that they're in the high 500s, low 600s, couple late payments on the report, and they required 15, 20% down to buy the home. So when it comes to how much you need to buy a home, the first part is your down payment, the minimum amount down to put towards the price of the home. A lot of people forget about the second part, closing costs, fees and services that are needed to buy a home. And when people say closing costs, and I'm the loan officer at the bank, automatically the assumption is, well, it's the bank fees. What does the bank charge to do the loan? Yes, banks do have closing costs. However, it's not the entirety. So when we throw out numbers like your closing costs are 3 to 5% of the price of the home, that could be $6,000, that could be $8,000, $12,000, right? Some people think the bank is charging me $12,000. It's not necessarily the bank. Bank is part of it, but there's also a few other fees and services that you use during the buying process in order to close on your home. One of them could be your homeowner's insurance. The banks require you to have a full year paid of homeowner's insurance so your home can be insured as of the day of your closing. That is an additional cost. So if your policy is $1,200 for the year, you will be paying an extra $1,200 on your closing costs for your home. Another one is your title company. The title company is in charge of making sure that the title, the deed of the home is fully transferred into your name. They also host the closing, so they have their closing costs as well. There's also taxes. There's also, attorney fees. So there's a lot of other fees that come into play when it comes to buying a home. This is where those first-time buyer programs come into play. So again, we go back to credit, 640 credit score for the IDA down payment assistance here in Illinois. 640 will save you $6,000. There's $7,500 programs. There's $10,000 programs. So it's a huge amount of savings that you'll get when closing costs are close to that amount. Now, I say to all my clients, it's one of the easiest when it comes to having the money. And people look at me like, well, what do you mean? When you're comparing it to everything else we just talked about, credit. We talked about 1 or 2 late payments can derail you for months. That's hard to bring up your score from the 4 to the 500s. And it takes time. It takes a year, 6 months, 18 months to get it to where you want to be. The second part is income. You make what you make, right? Unless you're going into some sort of career change, or if we're going back to school to get licensed in some special field, the income you make is generally the income that you have, and it's hard to change. Same thing with your debt. If you finance a $30,000 car that you're paying $650 a month for the next 4 or 5 years, it's hard to say, well, to buy a home, you need to pay off $30,000. But if we say to buy a home, you need to save up $2,500 or $3,500. To me, that's a little bit easier. Why? Because you're working. You can save a little bit more, tighten the belt a little bit, start to budget when it comes to saving for your down payment. Banks also allow withdrawals from 401k accounts, retirement accounts. They even allow gift funds from family. There's been many times where we've had borrowers that are getting married, or the family members want to help out on their first home. Banks do allow for transfer of money from an acceptable source. There's ways to document that, so please check in with me before you start transferring money. But generally speaking, once you include the down payment assistance programs, the cash to close is probably one of the easier things to get around when it comes to buying a home. And on top of that, if you have a really good realtor, and I know some, so if you need me to refer you one, let me know. A really good realtor will also try and negotiate seller credits. And what that is essentially is they're going to take it from the net proceeds of the sale, but they will kind of in turn give you a credit to lower your closing costs. So all in all, it's probably one of the easier steps to overcome, but we have to look at credit. We have to look at income. Those are probably the two major roadblocks that I see in clients trying to get pre-approved. I also want to tackle a few myths out there. A lot of people think you need a large down payment, whether you're a first-time buyer or a repeat buyer. That's not true. A lot of people think they need 20% or 10% down. We spoke about programs that require 3 to 5% down. A lot of banks sometimes advertise high credit scores being needed to buy a home. And yes, sometimes some banks do require a 680 or 700. That's why it's important to do the research and find out exactly how much of a score you need before you actually apply. Again, with my bank, 580 is the minimum to get you started. I wouldn't buy it at a 580 if possible. If you would maybe increase that a little bit more, it's definitely a better scenario. And sometimes that extra month or two might not be there. I've had clients to where they say, well, Johnny, my lease is up in 3 months and I'm either forced to renew it for almost double what I'm paying now, or I'm homeless. In that case, for sure, we'll do what we can to help you. And if we're in a scenario where we have to refinance in the future, for sure, we'll do that. But sometimes a month, 2 months, even 3 months of waiting and game planning to be in the right position will help you. I'm reminded of this particular client that we just closed on a few months ago. When we first sat down with her at the beginning of the year, she was at a 620 credit score. She had a few credit cards that were high in balance. And overall, she qualified to buy a home, however, with no down payment assistance. So if I remember correctly, she was bringing about $21,000, $22,000 the day of closing. Well, we came up with a game plan and gave her option A and said, hey, look, if you have this amount, this is what house you're going to get. This is the interest rate. This is the payment. But if you pay off these credit cards, I pulled a report for her. If you pay off these credit cards, your score will jump up to almost 700. You'll be able to get the down payment assistance program for $10,000. And now you're only bringing about $9,000 or $8,000 the day of closing. She took about 2.5 months to get those credit cards paid. And she ended up finding her house about 2 months later and closing about 3 weeks after that. So sometimes that delayed gratification, is a little bit better than buying right now. I'm at this house, I want to buy it, but I'm not in good shape. You're going to save yourself a ton of money and a lot of future money as well with the interest that you'll get. And that's it. It's not too complicated. At the end of the day, that acronym, that credit, income, assets, right? The CIA of mortgage is what you need to concentrate on. Everything else is scenarios, case-by-case basis. But in general, universally for all clients, we always look at your credit, we always look at your income, and we always look at your assets. So thanks for joining me in this special episode of The Final Walkthrough. If you have any questions, comments, concerns, or want to set a consultation, my team is always ready, and I will see you in the next episode.